for like 6 agonizing months, watching the uranium market has basically felt like sitting in traffic on a highway where absolutely nobody is moving.
Oh, yeah, it was the absolute definition of a market in suspended animation. I mean, the buyers were staring at the sellers were staring at the buyers, and nothing was happening.
Right. We were all just watching this flat line at $86.50, just waiting for someone to blink. But then last Friday happens, and the traffic jam finally breaks.
Yeah, the spot price actually broke out. It closed at 87.75. And over the weekend, we were even seeing intraday numbers touching 88, 87.
Which is just crazy. I mean, the ceiling we've been staring at for half a year is suddenly the new floor.
Exactly. And when a 6-month consolidation range shatters like that, I mean, the entire energy sector sits up and pays attention. It's a signal that the underlying tension might finally be snapping.
Right, which brings us to our mission for this deep dive. Welcome in, everyone. We are taking a massive stack of market intelligence for the week of August 24th through the 28th, 2026, and we're going to unpack exactly what is happening beneath the surface of this price spike.
Yeah, there is a lot to unpack this week.
There really is. Because whether you are tracking energy markets or, monitoring geopolitical shifts, or you just love seeing how massive global forces collide in real time, this week is an absolute masterclass in price discovery.
It really is.
So the question we have to answer for you today is this breakout a genuine seismic shift in the market, or is it just a temporary illusion?
Oh, to figure that out, we have to look at the volume behind the price move. And this is where the plot thickens a bit.
Oh, boy.
Yeah. TradeTech, which is, one of the main groups tracking these numbers, they noted that in the week prior to this spike, there was only one confirmed 100,000-pound spot trade.
Wait, hold on. Let's unpack this. One single trade.
Just one.
I mean, if I feel a single drop of water on my head, I don't run inside and declare that a monsoon has arrived. How on earth do we actually confirm a massive macroeconomic trend when the trading volume is literally a single transaction?
That is the multi-million-dollar question right there. I mean, when the spot market is trading that thinly on the screens, a single aggressive buyer can move the price just because nobody else is selling.
Right.
So to see if the monsoon is actually here, you have to look away from the screens and look at where the actual human beings are physically gathering this week.
Like where the real-world contracts are being negotiated.
Exactly. And this week, those human beings are all converging in Dallas, Texas.
Right, for NECX 2026, that's the Nuclear Energy Conference and Expo. Let's set the scene for you here. We're talking about the Hilton Anatole in Dallas. You've got over 1,000 attendees flooding into this building for 4 days.
It's a massive event.
It's huge. It's co-hosted by the American Nuclear Society and the Nuclear Energy Institute. So you've got utility operators, the people building the reactors, government regulators, and giant institutional investors, all literally locked in the same building.
And, the contrast between this week in Dallas and last week is super vital to understand. Because last week, the industry was down in Marco Island for the Utility Working Conference.
Right, which is famously off the record.
Exactly. It's all like quiet sideline chats in the hallway between a utility fuel buyer and a mining supplier. But NECX is entirely different. It's totally public-facing.
So it's all plenary presentations and major policy announcements.
Right, on-the-record keynotes.
Yeah.
It changes the dynamic completely. I mean, if a utility fuel manager just spent all of last week in Florida being told by 3 different mining companies that the long-term price of uranium is going up, they have to walk onto a stage in Dallas this week and actually answer to their shareholders.
They have to explain how they actually plan to secure fuel.
Yeah, on the record.
Let's talk about the difference between that spot price and the long-term price, because I think it confuses a lot of people.
No, for sure.
The spot price, which just hit almost $89, is like walking up to the front desk of a hotel at midnight and asking for a room. You just pay whatever they demand in that exact moment.
Right, it's immediate.
But utilities don't run nuclear power plants by buying fuel at the last second, right?
Well, they try really hard not to. Nuclear power plants prefer the term market. To use your analogy, the term market is like signing a 10-year lease on an apartment.
Okay, that makes sense.
It guarantees you have a place to sleep, and it locks in your costs so you can actually budget for the next decade. Utilities sign these long-term contracts to ensure a steady, predictable supply of uranium just to keep the lights on in their cities.
And the stakes for those utility buyers right now are genuinely terrifying. I mean, according to the Energy Information Administration data in our sources, U.S. utilities currently have 186 million pounds of uncovered uranium requirements between now and 2035.
That is a staggering amount of fuel.
It's crazy. That means they need 186 million pounds to run their reactors, and they do not have a signed lease for it yet. And meanwhile, the estimated long-term price indicator with the cost of that 10-year lease is sitting at $97 a pound.
Yeah.
That is a massive $9 premium over the spot price.
And that $9 premium is basically the clearest expression of the market's underlying panic right now. Because historically, the spot price is often higher than the long-term price, since you usually pay a premium for immediate delivery.
Right. The midnight hotel room should cost more.
Exactly.
Yeah.
But right now, the market believes long-term supply is so dangerously scarce that producers are demanding $97 to guarantee future delivery. But, and this is the crucial part, that $97 is just a published estimate right now.
So what we're really watching for in Dallas this week is someone actually signing on the dotted line to prove that $97 number is real.
Spot on. We are watching for any disclosed long-term contracts. Because conferences like NECX are historically when companies announce these major deals.
Right.
So if a producer announces a new contract this week and they disclose the price, it acts as an anchor for the whole industry. If a contract is signed above $90 a pound, it proves that this elevated term price isn't just a guess.
It's the new reality.
Right, the market is officially clearing at 90 plus.
Yeah.
But, if someone announces a contract below $85, well, that throws a massive wrench into the whole bullish narrative.
So because these Western buyers in Dallas are just so desperate for term contracts, the power in this dynamic clearly sits with the sellers.
Absolutely.
Which brings us to the people actually digging this stuff out of the dirt, and specifically to Wednesday's massive data event, which is Paladin Energy's full-year results for fiscal year 2026.
Yeah, Paladin is such a fascinating case study right now. They operate the Langer Heinrich mine down in Namibia. And this mine, it basically sat dormant in what the industry calls care and maintenance for an entire decade, just due to low prices.
Right. They basically turned the lights off and walked away for 10 years.
Exactly. But it finally restarted production back in March 2024. So Wednesday's results are the very first complete annual report showing a full financial year of a restarted operational Langer Heinrich.
And their recent quarterly data looked pretty solid, right? Like Q3 showed them producing 1.29 million pounds, which was a 5% increase over the prior quarter.
Yeah, the ramp-up trajectory seems to be on track to hit their nameplate capacity.
Which is what exactly?
Nameplate capacity is essentially the theoretical maximum speed limit of the mine. It's what the engineers designed the facility to produce if literally everything runs perfectly.
Okay, so the engineers say it can hit a certain number, and on Wednesday we find out if the actual physical reality matches the blueprint. So what specific numbers are the big institutional investors looking for in this report?
Well, there are three main metrics. First, the total fiscal year production, which they expect to land between 4.5 to 5 million pounds.
Okay.
Second, their forward guidance for next year, where they're targeting 5.5 to 6 million pounds. And finally, their C1 cash costs, which they've guided to be under $35 a pound.
Okay, stop right there. I need to push back on this because the math you just laid out is basically breaking my brain.
Okay.
You define C1 cash costs as the basic ground-to-gate cost of pulling the uranium out of the rock before corporate taxes and office overhead.
Right. That is the standard industry definition, yeah.
Okay, so if the spot price is pushing $88 and Paladin is pulling uranium out of the Namibian dirt for under $35, I mean, that is a massive, monstrous profit margin.
It's huge.
If I could make a product for $35 and sell it for almost $90, I wouldn't just be gently ramping up production. I would be running those machines 24/7. I'd be mortgaging everything to dig faster. Why aren't they scaling up more aggressively? Like, what is the catch here?
Well, the catch is that mining isn't a software company, right? You can't just buy more server space to scale up.
Fair point.
You're dealing with physical earth, heavy machinery, chemical processing, and massive human logistics. You just can't flip a switch to double production. And that tension you're pointing out, that is exactly what investors will be scrutinizing on Wednesday.
Because they have to prove they can actually maintain that margin.
Exactly. Right now, Mid-tier uranium producers like Paladin enjoy this premium valuation in the equity markets. Their stock prices are built on the assumption that they can smoothly capture that massive $50 margin at scale.
But if they hit a physical snag,
If those C1 costs come in at $45 instead of $35, or if they admit they can't hit that 6 million pound target next year because of equipment issues, that premium valuation gets severely punished.
right?
A slip in the physical ramp-up means the cash flow models just break down. Paladin has to prove that scaling a mine after a 10-year hibernation is actually as profitable in reality as it looks on a spreadsheet.
So Paladin, a mid-tier player, is desperately trying to prove they can scale up to meet this panicked buyer demand. But the reality is the market is really relying on the biggest producer in the world to fill this gap.
Yep.
And the biggest producer physically can't. So let's talk about Kazatomprom over in Kazakhstan.
Right, so the market is still aggressively digesting Kazatomprom's first half 2026 results that dropped last week.
And what did those look like?
The headline financials were honestly a mixed bag. I mean, revenue was up 9%, but net profit was down 9%. And their average realized price for the half year was sitting around $67 a pound.
But the financial numbers aren't even the most vital part of their report, are they?
Well, not at all.
It's the bottleneck they announced. And I have to say, the global nuclear energy supply chain is currently being throttled by, and I'm not kidding, archaeological discoveries. You genuinely cannot write this stuff.
It sounds totally absurd on its face, right?
Yeah.
But when you look at the mechanics of how Kazatomprom operates, it has massive macroeconomic consequences. Kazatomprom relies almost entirely on something called in situ recovery mining, or ISR.
Okay, I have to pause you again, because whenever I picture a mine, I picture like a giant crater in the earth with dump trucks the size of a house driving out of it. How does in situ recovery actually work?
Okay, imagine making a cup of tea, but underground.
A cup of tea? Okay.
Yeah, so instead of digging a massive hole and moving millions of tons of rock, ISR mining involves drilling a well and pumping a specialized chemical solution, usually sulfuric acid, directly into the underground ore deposit.
Oh.
Yeah, and the acid basically dissolves the uranium right there in the rock. Then they pump that uranium-rich liquid back up to the surface and separate the uranium out.
So they're basically chemically brewing uranium underground,
That's exactly it.
which means without the sulfuric acid, the entire operation just grinds to a halt.
Exactly the problem. To sustain their production growth, Kazatomprom uses vast amounts of sulfuric acid. And lately, they've been buying it from outside vendors whose prices just jumped 39% in the first half of the year.
Ouch.
Yeah. So to fix this, Kazatomprom has been building their own massive facility, the TQZ sulfuric acid plant.
And in the report, they announced that the completion of this critical acid plant is being delayed.
Right.
It's pushed back to somewhere between the third quarter of 2027 and the first quarter of 2028. And the reason given is that they found archaeological artifacts at the construction site.
Yeah.
So because someone found some ancient pottery in Kazakhstan, the world's largest uranium producer doesn't have enough acid to brew their underground tea. What does this actually mean for global supply?
Well, it basically creates a hard physical ceiling on production. The market has been fiercely debating this idea of supply discipline. Some analysts looked at Kazatomprom's 9% production increase earlier this year and worried they were going to flood the market and crash the price.
But without the new acid plant, they physically cannot flood the market, even if they wanted to.
Exactly. Sell-side analysts from major banks like RBC, Citi, and BMO, they're all updating their production models this week. If the consensus becomes that this acid plant delay places a hard cap on Kazatomprom's ability to expand production into 2027 and 2028, then that supply discipline narrative is entirely intact.
Right.
If the world's biggest producer is physically constrained by a lack of acid, that $97 term price we talked about earlier becomes incredibly defensible. There simply isn't a flood of cheap supply coming to save the utilities.
So, if you are a Western utility buyer sitting in Dallas this week, you are sweating.
Big time.
You see Paladin struggling to ramp up an old mine, and you see Kazakhstan capped by an acid shortage. Naturally, you start looking elsewhere for supply. But when you look elsewhere, you aren't just competing with other commercial power plants anymore, are you?
Wait.
You are running straight into geopolitical roadblocks and sovereign nations.
And this is a profound structural shift in how the uranium market operates. We have to look at India for a second. India's state-owned power company, NTPC, has a 70% import dependency for uranium.
70%? Wow.
Yeah. They need 5,400 tons annually just to fuel their current and expanding reactor fleet
Annually.
every single year. So for a massive, growing nation like India, this isn't just about commercial economics. I mean, it is a stated national security priority to achieve fuel self-sufficiency.
And they aren't just calling up a broker to buy pounds of uranium on the spot market. They're taking a much more aggressive approach.
Yeah, they're trying to buy the actual earth the uranium comes from. NTPC issued a formal tender to acquire overseas uranium mines, targeting assets in Canada, Australia, Kazakhstan, and South Africa.
That's bold.
The bids for that tender actually closed back on July 16th. By all historical timelines for sovereign procurement, their shortlist for due diligence is now overdue. I mean, we could see an announcement any day.
But wait, why does an Indian state-owned company buying a mine in Canada matter so much to, say, a utility buyer in Chicago?
Because it completely removes that supply from the commercial pool. I mean, when a commercial miner pulls uranium out of the ground, they sell it to the highest bidder on the open market. But when a sovereign entity like India buys a mine, they are producing that uranium to sell it.
Right.
They are boxing it up and shipping it directly to their own domestic reactors. It is a concrete, quantifiable reduction in forward supply optionality, and it's happening at the exact moment. Western buyers are desperate to secure long-term contracts.
So it's like finding out the grocery store is out of apples, not because someone bought all the apples, but because someone bought the entire orchard and put a fence around it.
That is a perfect way to visualize it, yeah.
And if sovereign hoarding wasn't enough to induce a panic attack for these fuel buyers, we have to talk about the ultimate geopolitical wildcard this week, which is the stockpile sitting in Niger.
Oh, this situation is wild.
We are talking about 1,050 tons of Soma uranium worth roughly $40 million that has just been sitting on the tarmac at the Niamey airport since November of last year.
It is entirely frozen in this terrifying legal limbo.
Yeah.
Following the nationalization and all the political upheaval in Niger, an international arbitration tribunal, the ICSID, issued a provisional measures order.
Which means what, exactly?
It explicitly bars the government of Niger from selling or transferring that material to any third parties.
But Niger's government clearly doesn't seem to care about the International Tribunal because they started physically moving the stockpile in February and have publicly stated they intend to sell it. And we know Romania's state nuclear company showed interest in buying about 300 tons of it back in April, though they've denied any deal has actually been signed.
Well, Niger defies the International Tribunal and actually signs a binding contract with a buyer. It triggers a legal trapdoor. Orano, which is the French nuclear giant that is the majority owner of the Somaïr mine, has explicitly threatened to sue everyone involved.
Everyone.
Everyone. They will sue the buyer, they will sue the transport company that moves it, and they will sue the financial banks that clear the transaction.
So if a utility tries to buy this discounted uranium to solve their supply problem, they aren't just buying fuel. They are buying a massive multinational lawsuit. It's legally radioactive.
Exactly. It would trigger a multi-front, multi-jurisdictional legal crisis with absolutely no modern precedent. I mean, you'd have enforcement actions in France and the buyer's home country, in Niger, and at the International Tribunal.
That sounds like a nightmare.
The market read on this would actually be short-term bullish for the price of uranium, because that material is essentially permanently removed from the usable supply chain while the lawyers fight over it for years.
But long-term, it sets a terrifying precedent for the rule of law in any post-nationalization environment. And it's not just Niger adding a risk premium to the market. We also have the ongoing gray zone tension in the Strait of Hormuz.
Yeah.
Now, to be clear, uranium doesn't physically travel through the Strait of Hormuz on ships, right?
No, it doesn't. But the ongoing naval tension and the U.S.-Iran friction there serve as a constant blaring siren for global energy security. Every single week that Middle Eastern energy logistics are under threat, it validates the policy argument for nuclear power.
Right, it's a reminder.
Yeah, it reminds policymakers in Washington, London, and Tokyo why they need geographically diversified fuel chains that do not rely on oil and gas in the Middle East. That tension keeps the global energy security premium extremely high, which basically indirectly supports everything we are seeing in the uranium market.
Okay, let's tie all these massive threads together. We've got desperate utility buyers forced to speak on the record at NECX, Paladin trying to prove its physical profit margins, Kazatomprom bottlenecked by an underground tea brewing acid shortage, and this terrifying legal standoff over an airport tarmac in Niger.
It's a lot.
It's so much.
Yeah.
But all of these pressures funnel directly into one single defining moment at the very end of the week.
Friday. Everything culminates on Friday when TradeTech publishes its weekly spot price indicator. We will see if the price actually holds above $87.75.
But it's not just the spot price print we are waiting for on Friday. There's another massive catalyst hanging over the end of the week, which is the Westinghouse public S1 filing window opening.
Yes.
Let's pause here. What exactly is an S1 filing, and why do we care about Westinghouse when we are trying to value uranium miners?
Good question. So, an S1 is the initial registration form a private company must file with the SEC before it can go public and sell shares. It is essentially the blueprint of a company's finances. And the reason this matters to the uranium market is that Cameco, which is one of the largest uranium miners in the world, owns 49% of Westinghouse.
So Cameco is a public company, but they own half of a massive private company.
Which creates a huge problem for financial analysts. Cameco has been trading at a persistent discount to its consensus targets because it is incredibly difficult for analysts to accurately model the dollar value of Westinghouse without looking at their internal books.
So it's basically a mystery box.
Exactly. Westinghouse is essentially a valuation black box. But Cameco in Brookfield filed a confidential S1 with the SEC at the end of July, and that 30-day SEC review window closes this Saturday.
Meaning by Friday, we are entering the zone where that confidential filing could become public?
Right. Once that S1 goes public, the black box is opened. Analysts can finally assign a hard mathematical dollar value to Cameco's 49% stake. It provides a valuation floor.
That makes total sense.
Yeah, so if Cameco announces that public filing, especially timed with the NECX conference this week, it acts as an immediate, direct catalyst for Cameco's stock, which lifts the entire uranium equity sector.
But the ultimate test for the physical commodity itself remains that TradeTech spot number on Friday afternoon.
Absolutely. And there are two starkly different paths for Friday. Path 1, the weekly indicator holds above $87.75 for a second consecutive week, and it does so with actual trading volume generated by the utility buyers panicking in Dallas.
Right. And if it does, then the breakout is real. The 6-month staring contest is officially dead. Technical buying from financial entities like the Sprott Physical Uranium Trust will probably kick in, and we are looking at a fundamentally new price floor.
But then there's path 2, the price falls back below $87. In that scenario, last week's spike was just a single trade distortion. The breakout was an illusion, and the agonizing wait continues right into September.
And this is exactly why we do these deep dives for you. Because right now, there are thousands of casual observers just staring at a flat price chart, wondering why a line ticked up $1 on a Friday. But you now understand the hidden mechanics driving that line.
You have the context.
Exactly. You know that it's connected to boardroom panic in Dallas, physical mining constraints in Namibia, sulfuric acid shortages in Kazakhstan, and a geopolitical legal war over a tarmac in Niger. You have the upper hand on the narrative.
Because the chart just tells you what happened in the past. The context tells you what's going to happen next.
Perfectly said. So, as we wrap up, I want to leave you with a final puzzle to chew on, building on what we discussed about India. Think about NTPC trying to buy entire overseas mines. If the world is shifting away from an era of buying fuel on the open commercial market to a new era of sovereign nations hoarding the actual earth it comes from, what happens to the commercial utilities left completely empty-handed?
It's a scary thought.
Are we moving toward a future where uranium isn't just a traded commodity, but a heavily guarded national security asset? And if so, what does that single drop of water on the spot market turn into when the real supply monsoon hits? Something to think about. Thank you for joining us for this deep dive into the uranium week ahead. Keep your eyes on Dallas, watch the tape on Wednesday, and we will see you on the other side of Friday's print. Take care.